Today sees the release of Brazilian inflation data. In light of this, I've invited Dr. Win Thin of Brothers Harriman to share his short, mid and long-term forecast for the dollar Brazilian real on this Wednesday's forecast interview. Win, welcome. The Brazilian real strengthened against the dollar Monday to levels not seen since October, as markets expect an inflow of dollars in the coming days and continued low interest rates in the US. Your one-month forecast is set at 215.
Yes, as you probably know, the sentiment on emerging markets has turned quite positive in recent weeks. Obviously, 2013 was a very tough year, and that carried over into January. But really, since February, March, and into April, EM has been on a tear, and we expect the Brazilian real to continue to be one of the beneficiaries of this positive sentiment. Money is back to chasing yield. Brazil yielding 11% right now. It looks quite attractive in the world in which developed market interest rates are still quite low.
Your 3-month forecast pictures the dollar real at 220. A pre-election rally, perhaps?
Well, actually, that's a little bit of a pre-election softness. The election is in October. The polls suggest that President Rousseff will still squeak out a victory. Her support has been falling in recent weeks, but the opposition really hasn't been able to cash in on this, has not been able to capitalize on her falling popularity. They remain stuck down around the 10-15% popularity range. So right now, it's Rousseff's the race to lose. But despite that, we do expect some sort of election-related jitters to sort of crop up in Brazil, and so we could see some profit-taking ahead of those elections over the summer.
A long-term forecast of 225 is in keeping with analyst bets that Brazil will let the real appreciate in an effort to tame inflation. But with concerns that appreciation could hurt the country's already weak exports, is there risk of a move before that year is out?
We look to it for the real to firm over the next month. The rally continues. Then, 3 months, 4 months out, the election kind of starts getting into people's radar, and that means the real will start to soften and move from 215 up to 220. And then, 1 year out, that's when I think the markets will be focused on when the Fed is going to hike rates. And that's why I have the real softening even a little bit further. The start of the Fed rate hike cycle in 2016 is probably the biggest risk event right now to emerging markets, but that's the bad news. The good news is that's still a year plus out. And so I think that's one of the reasons why the EM rally has really gained traction over the last several weeks, is that, despite the tapering, the U.S. economy is starting to recover from weather-related softness in Q1 and other factors, but not strong enough in order to speed up tapering or to, in fact, bring forward rate hikes. So we've reached a bit of a sweet spot for emerging markets, and that's why I think the real and other emerging markets could gain some traction or continue to gain traction over the near term. But 1 year out, I think it will be dangerous when the Fed hikes. That typically causes turmoil for the emerging market countries and currencies.
Dr. Win Thin there of BBH. Coming up today on Dukascopy TV, Durham McDermott will be bringing you the latest on German data, and Ben Jones has a Toyota story for you in today's press review. Goodbye for now.